Welcome to TheoTrade. This is Don Kaufman. Here we are. It is November 28th, 2016. You are watching the Theo Night video. We've got just about 7 minutes left to go in the trading session here. And the S&P futures are just about a point shy of the oh so round number of 2,200. Now, rather than go into really specific or individual stocks over here, right now, I want to give you a quick kind of, state of the union of what the marketplace is doing, and more specifically, all right, what to look for in the coming days and coming weeks over here. So first and foremost, again, I think the 2,200 level is a fairly critical psychological level, nothing more. The point to be made, though, over here isn't that the S&Ps are going to close below, or very close to this key threshold over here. Reminder, there's still a few minutes left to go. It's very likely we could rally right back to the 2,200 level and close there on the button. It's the fact that what's strong and what's weak, okay? The NASDAQ is actually strong relative to the S&Ps. With the Russell, the Russell is kind of the talk of the trading community right now. It's getting hammered into the close. That is a 1.5% decline. Now, need I remind you, the Russell by far and large has been the strongest product as of late. In fact, I've actually discussed time and again on some recent videos, short the Russell, and I was specific to the IWM. Okay, so today is the first decent decline that we've seen inside of the Russell product. Neither here nor there, all right? Oh, come on, how many up days in a row can you possibly have? This is literally the first red candle that you see on the screen, okay, since, well, I'll give you exactly since 11/4. That's right, people. November 4th. Okay, the streak ends today from November 4th to November 25th. Not one red candle on the screen. Giving it back, of course, in today's trading session. So that does speak volumes, because if you took a look at a recent comparison that I did, and I'll display this versus the Qs, but this is something I've brought up a tremendous amount lately, and I want you guys to be very, very comfortable with it. It's the QQQ versus the spiders versus the IWM. All right, in this comparison chart, the move, all right, on the top product over here, and I will denote this right up here. This is the IWM, okay? What do we have right here, of course, is the Qs, and down below is the spider. Of course, this is nothing less than a statistically significant move. It's just drastic versus the other products. And again, today, you're actually seeing the Russell come in substantially more than the S&Ps and the NASDAQ. All right, could be a sign. Could there be some sell-side activity? Sure. But just to view how statistically significant this move happens to be, you realize you can even open this on a 5-year chart and you can still see the convergence. Look at the Russell, all right, leaping beyond the spiders and reaching for the top performing product over the last 5 years, being the NASDAQ. Nevertheless, so we're short right now, the Russell, okay? Pretty clear, pretty decisive. Again, I did not use the IWM. I went out and shorted the full Russell future out there. So again, I'm short the Russell future. Now, continuing on over here to display a few products. To me, one of the things that really stands out today isn't necessarily the fact that the market's given up a small, 0.5% over here, okay? What stands out, number one, the volatility futures. The volatility futures on an intraday basis, they're not really responding to this down move at all. They're shrugging it off. The volatility futures have moved up a whopping 17 cents, with the S&Ps down 11 and the Russell down almost 20 handles right now. So in effect, what does this mean? It means, well, it's roughly a nothing move, okay? It's meaning that the marketplace, it's not feeling the fear, at least not yet. Keep it in mind. Moving on down the list over here, I think one of the other really pivotal areas in coming trading days, and this is much more forward looking, you've got to be looking towards the bonds, all right? So we'll look towards, again, the beginning of the bond decline. Now, you can look at the bond decline as starting all the way back here in July I would, disagree a bit with that. Bonds have been slipping a little bit, but they really hit the accelerator after, of course, the presidential election. The bonds were trading roughly the 163 handle, dropped out. Today, the bonds actually rolled forward, but roughly speaking, they're all the way down about 10 full points. That's 10 full bond points over here. Now, with that, if you've never looked at this before, this is the TNX. That's the 10-year treasury. So I was looking at the bond, which is relationship to the 30-year, but this is the 10-year, okay, ultimately the interest rate associated with it, and it's exploded higher. Now, the reason I bring this up, sure, higher interest rates are going to help financials substantially, but at what point, okay, in this realm over here, do interest rates take off far enough to the upside where they become prohibitive? To what? Well, again, a rise in interest rates can be spectacular. The banks are sitting on billions, and some of the banks even trillions of dollars of client assets that can yield next to nothing. Well, all of a sudden, the interest rates come up. But if interest rates explode higher, it all of a sudden is looked at as being a negative. Why? Well, then nobody wants to get a mortgage. Then it's more difficult to get a car loan, and it goes on and on and on and on. Credit card interest rates are also going to be linked into the 10-year. And immediately, if you see a rise in rates, everybody thinks it's a great thing. Then if rates explode higher, everybody turns around and goes, this is going to be a bad thing for the entire economy. So again, it's a double-edged sword. What you want to look for in bonds in just days to weeks to come, if the bonds, okay, just kind of softly slip lower, again, you could see more upside potential to the marketplace. However, if the bonds sell off hard and fast, if they break through the 150 level with some furious trade out there, I believe it takes the market the exact opposite way. That's when you're going to start to see a little bit of panic, a little bit of fear out there, and they're going to hit them. And I mean hit the S&Ps, all right? So there's a scenario here where the bonds start trading down heavily and hard, interest rates start to get out of control. Again, traders start to panic and they start to hit the S&Ps. In that particular circumstance, what they'll do is they'll sell S&Ps, they'll sell bonds, and they'll turn around and they'll buy the dollar. Now, you don't see that today. Today, you've actually got a bounce effect. There's the bell. Look at that, 2200 on the button. But we called that. Now, if you take a look at the bonds and the idea of the bonds bouncing, negative for the marketplace. All of a sudden today, correlation started to grip hold again. And that is, if you see the bonds starting to rally, look, it's having negative implications to the XLF. It's one of the first down days we've seen in the XLF as well. And again, today's move, it's in line almost with what you saw in the Russell. It's 1.25%. So great. Where do we actually stand there? You're like, wait. So if the bonds in this particular circumstance, and again, we're going to look as objectively as we possibly can at the bonds. If the bonds rally, it's negative implications for the marketplace. Okay? And I want everybody to be kind of comfortable with that idea. So again, if the bonds rally, it's going to have negative implications to the S&Ps. If the bonds kind of cruise down here, nothing crazy, just continue their sell-off over here, it can actually have positive implications to the S&Ps. If the bonds sell off hard and fast, if they break through 150 in the next couple of days, put your helmet on. The volatility could be absolutely extreme in the broader marketplace out there. And these are all things to think of again, but it's the bond market right now that traders are looking towards. Again, people always point out it's this market, it's that market. All right, look at Amazon over here. It doesn't matter. It's inconsequential at this point. All that's really going to drive the broader markets is what's going on with the relationship between bonds, okay? The recent rally in the dollar, this is making everybody nervous right now. I mean, nobody has, why is everybody in the world buying dollar? We don't know. We can only theorize that this has a lot to do with risk in the marketplace. Why does everybody all of a sudden start, selling out of bonds? Okay, well, apparently they're getting ahead of what the Fed is likely to do, and the Fed is likely to raise rates. Okay, markets are all about, not anticipating, but markets are just going to move prior to you realizing why they are moving. And I'll give you a prime example of that, and I'll leave you with this thought tonight. If you took a look at Amazon, and Amazon happens to be down almost 2% today, Yet everything we heard this weekend, and this was, the Thanksgiving weekend here, Black Friday, didn't online retailers absolutely just kill it in this particular Black Friday? Not even so much Cyber Monday, which is today, but they did extremely well. Now, if you heard that news like I did on Saturday, and this past Saturday, I heard this news, you would have thought the exact opposite of Amazon. Again, markets, not about anticipation. We don't have a reason for the move up in the dollar. Could be a little bit of a fear trade. We don't know exactly, all right, what's going on in the broader bond market. All right, this is anticipation maybe of interest rates that are starting to appreciate. No, it is driving interest rates higher. That's what we know. The volume in here is fairly extreme. All right, is the beginning of like bond Armageddon where the bonds sell off into an oblivion? If so, the interest rates will go skyrocketing. It'll stall out the entire economy over here. We are at pivotal levels in markets. Okay, in the S&P 500, I will continue to urge you. The risk in the market right now is to the downside, meaning that there's so much more downside potential than the upside capability of the S&Ps that, again, if you're long, and I mentioned this the other day, if you're long markets in any way, shape, or form, you just have to remain extremely nimble. There's still money to be made to the upside here, okay? However, the downside holds the best opportunities at this point. Thanks, everybody, for joining us here at TheoTrade. Join us all this week in the TheoTrade chat room. Have a great evening. Bye-bye.